Fundamental analysis is one of the key aspects of everyday life for every trader and investor who is fascinated with crypto. This type of analysis involves taking a deep dive into everything about cryptocurrency and that specific token. The primary goal of undertaking any fundamental analysis is to reach a conclusion about whether or not an asset you are going to invest into is worth it. And that's what this video is all about. Hey guys, Shad here with the EXMO cryptocurrency exchange. In this lesson, we will focus on fundamental analysis and how you can leverage it to your advantage. Fundamental analysis, or FA for short, is an approach that is used to evaluate the intrinsic value of an asset. The main goal of FA is to combine internal and external factors related to a certain asset to identify whether or not it is worth investing in. The information provided from fundamental analysis can really serve as a leverage to strategically enter or exit your positions. In a traditional way, the FA approach takes business metrics to figure out the real value of an asset. The indicators that are used in traditional FA are as follows: earnings per share, i.e. how much a company makes for each share; the price to book ratio, i.e. the investor evaluation of a company versus its book value. Still, when we talk about FA for cryptocurrencies, we must tweak this approach just a little bit. The first difficulty with FA for crypto is that, well, cryptocurrency projects can't be evaluated as traditional businesses. Due to the decentralized nature of it all and decentralized nature of cryptocurrencies, traditional fundamental analysis methods don't actually really work. However, there are metrics and data points you can explore when carrying out FA. So let's start with the very basics. The first thing you need to do is to obtain data for your crypto project of choice. I recommend using CoinMarketCap or CoinGecko when starting your FA. The straightforward on-chain analysis can provide you with a lot of information about a cryptocurrency. You can start with a transaction count. It's a good measure of the activity and utility within a network. However, you need to be cautious when handling this data. It might involve funds being transferred between the same wallets, or wash trading. Transactional value is the second parameter you should review. This indicator informs us about the volume of funds that have been transferred within a certain period of time. The number of active addresses in the blockchain can indicate whether the blockchain is still alive and running also. Very useful. The approaches of how to calculate these numbers may vary. The most popular method, let's say, is to count the number of senders and receivers of each transaction during a certain time period. Also, don't forget about the fees paid in the blockchain. It can tell you a lot about the demand for the block space. They might look like auction biddings. The more bidders, or in our case, miners you have on the blockchain, the better the blockchain is. The raw data that you obtain from CoinMarketCap and CoinGecko will certainly be useful also. What you also must take into consideration is a hash rate and the amount staked. Hash rate is used to measure network health in proof-of-work consensus algorithms. The higher the hash rate, the more difficult it is to successfully launch a 51% attack. The increase in hash rates also indicates the growing interest in mining. At the same time, however, the lesser the hash rate, the lesser the number of miners. The key factors that might influence the mining processes are as follows. For example, the current price of the asset, the number of processed transaction fees, the amount of stakes is also related to the proof of stake consensus cryptocurrencies. The more stakes you see on the network, the better the chances that this network will be valued more in the future. Now, when we have finished examining on-chain data, we must look into project metrics. A white paper on cryptocurrency can be defined as a company's business plan, essentially. It contains all the necessary and relevant information you need before deciding whether to invest in a project. Ideally, any good white paper contains the following information. So first and foremost, it should include the technology that the project uses, the use cases of the project, and its roadmap of future upgrades and new features. It should also show you the token supply distribution scheme and the consensus protocol it's using. When you have sufficient information on the goals and technologies behind the project, you should start digging up and querying information on the project's team. If there is a specific team behind the project, the track record of team members should reveal quite a lot about their skills and experience. The point here is that you need to determine if the team has enough developers with the needed reliable expertise to put off the project that they're saying they're going to do. One more thing you need to do is identify when analyzing the team is their reputation. What are they like in the market? You don't need to have coins with a dubious reputation in your wallet. There's just no point. But what if there is no team? What if it's anonymous? In this case, there is usually a public GitHub page for the project. You'll need to look at the developer community of said project and see how active it is. Don't forget to also investigate the competitors of the project you're analyzing. A white paper usually gives you an understanding of what audience the crypto project is targeting. So identify this audience and look for other projects which also seek the approval of said audience. Your first product of choice might be appealing, but only when you compare it with other similar projects will you then be able to see the weaknesses. Another thing you should pay close attention to is tokenomics. Very important. Whether a token has real utility. The utility is also something that the majority of the market must recognize and evaluate. Another thing about the tokenomics is to learn how the funds were initially distributed. Was it through an ICO, IEO, IDO, or a pre-mine? The white paper should clearly provide this information. The initial distribution might provide some idea of any risks that exists on the project and its blockchain. So when you have gone through all non-financial metrics that the project has to offer, it's time to get down to its financial metrics. The first thing that you need to pay attention to is the market capitalization of your project. What's the market cap? The easiest way to calculate the market cap is to multiply the total circulating supply of tokens and the current price. However, capitalization might be misleading. In theory, a project can have 10 million coins with the trading value of $1 for each coin, but most of these coins might just be dead, so to speak, meaning that they exist, yes, but nobody develops, sells, or buys them. For now, they're useless. Nonetheless, market capitalization is used extensively to figure out the growth potential of any networks and projects. You should also be looking at liquidity and volume, which are two other important financial indicators. Liquidity means how quickly and easily you can exchange your asset for another one. Trading volume helps to determine the liquidity also. You can see the trading volume from the charts for a certain time period. The more volume you see, usually the better liquidity, almost always actually. Supply mechanism is the most interesting financial indicator used in fundamental analysis. Some projects reduce their coin supply over time, while others, on the contrary, create new coins over time. In both cases, it should affect the price of coins, and you must determine whether it's a good or bad for your overall investing strategy. Done correctly, your fundamental analysis can provide essential insights into the project you are analyzing. And don't forget that the true value of crypto is very hard to calculate, and the market might sometimes be wrong, or always is wrong, who knows. Fundamental analysis is just a way of predicting the future value of an asset, and sometimes an asset that might have been appealing in the past will not be the same level of appeal in the future. That's just a reality for any trader or any investor's life. That's it for today's video. I'll see you in the next lesson where you will learn even more interesting facts about the fascinating world of investing and trading in cryptocurrencies. My name's Shad. Bye for now.